Last September, the Federal Reserve began an exercise designed to test the operations of its overnight fixed-rate reverse repurchase program, sometimes referred to as the reverse repo or the RRP facility. The Fed's interested in understanding how it could use this program to control interest rates. In a reverse repo transaction, a money market fund or another eligible counterparty makes an overnight collateralized loan to the New York Fed, and the Fed in that way can withdraw liquidity from the financial system. Now, the facility may eventually become an important monetary policy tool for the Fed when it decides to start raising interest rates. Our study focused on money market funds that invest principally in Treasury and agency securities, looking at changes in the investments that those government money funds made in the Fed facility after it was launched last September. Now, these funds can either invest directly in Treasury and agency securities or in repurchase agreements. And the data show that after September, when the program began, the volume of investments did increase sharply. One of the interesting findings from the study was that while the volume of investments in the Fed facility was rising, the investments made by money funds in repurchase agreements with broker-dealers, who have historically been big players in the repo market, actually fell. And there might be a couple of reasons for that. The first is that the fixed rate offered by the Fed is attracting assets away from these broker-dealer repos, but it might also reflect some regulatory factors in that broker-dealers now have had to reassess the economics of short-term funding in light of regulatory changes under Basel III. One of the factors that's influenced the volume of activity in the overnight program over the last several months has been the terms offered by the New York Fed. The overnight fixed rate offered has risen from 1 basis point at the start of the program last September to 5 basis points now, and the per counterparty investment limit has been raised to $10 billion. So one factor that investors may want to focus on in coming months, especially as we get closer to a time when the Fed may tighten monetary policy, is how further changes in the terms of the program might influence flows into the RRP facility. Now, the Fed's already demonstrated that it has the ability to influence short-term money market flows, but further changes in terms could have additional impact. And eventually the RRP rate could serve as a rate floor in the market, and the Fed could use it as a tool to drive interest rates up across the board when it does decide to tighten monetary conditions.